All right, well, welcome back to the iWealth podcast, and today we're joined by Mr. Brad Connors here, and we're talking a little bit about last quarter. Q1 is in the books, and what all happened?
Well, there was a lot that happened in Q1, but you go back to 2022 and take a look at the market being down from anywhere from 18 to 33% roughly in different indexes for stocks, and bonds being down 13%. Like, at some point we had to get some positive momentum, and we did. So, last year you had the S&P, last quarter, you had the S&P up about 7.36%. You had technology led the sectors of 21%. So we had a nice bounce in the first quarter. And even more important than that, the bonds were actually up almost 3%. The Barclays Agg was up like 2.9 or something like that. So you had bonds positive finally. Last year was an anomaly. They were down 13%. It was just kind of unheard of unless you go back to the 70s. And then we finally had some good momentum on the stock. So fingers crossed, the statements when they show up in the mail will look better this first quarter.
Look a little bit more on the positive side than they did at the beginning of the quarter.
Yeah.
What about the banking side of it? What's happening there?
Super interesting. Really interesting. One of the managers that we use that manages money for us at iWealth, he's been talking for 9 months, 12 months. He's been saying, Brad, the way these things typically end, and meaning the way they end with the Fed raising interest rates so fast, is something has to break. And so, we had the deal with FTX, and I called him and said, is this it?
All the Bitcoin stuff?
Yeah, is this it with Bitcoin? He's like, Bitcoin's not big enough. It's not it. We had a company called Credit Suisse, a bank overseas that had some issues. And I said, is this it? He said, if they go bankrupt, yes, this is it. But that didn't happen. And then all of a sudden you wake up and you hear about the Silicon Valley Bank deal that happened in California. And then there was another bank in New York. And so that catalyst, phone call, is this big enough? Yes, it's big enough. So, unfortunately, something had to break. We believe that was the break. And so we'll find out. Nobody knows for sure, but we'll find out. All that means is this: a recession most likely has already happened or will happen. The market is 6 to 9 months ahead of that recession.
Okay.
So maybe we're going through it right now, but by the time they say, hey, we're in a recession, we'll be through it from the stock market perspective. And the breakage that we had didn't hurt everybody. The Fed bailed them out. We can have a whole discussion about whether that was right or wrong. But we believe that breakage helps the Fed to pause. So maybe they go another quarter, and then maybe they're done and raising these interest rates. And the market can kind of settle out here, this spring and summer, and then, fall to next year. Hopefully things get a little bit better. But yeah, it was really interesting when you saw the banks and
the run on the banks that everyone got all excited about.
Yeah. What's interesting about that, Matt, is there was a company in the Wall Street Journal I read about that had $1.1 billion. A company had $1.1 billion, and they had half of it in two different banks, both insured for $250,000. Now, it makes no sense. If I was running the company that had $1.1 billion in cash, I don't think I would just stick in two banks. I don't care what banks they were. They just didn't do a very good job of controlling what was going on with their balance sheet. But the government did make them whole, and they'll be okay, and the companies are fine, and met payroll and all that other kind of stuff. But it's just an unnecessary thing that happened with these banks. They got caught. They took in a lot of money. They bought government securities. The Fed raised interest rates, and it broke.
Yeah. So that kind of brings us up to speed for where we're at right now.
Yeah.
What's on the horizon? What should we be looking forward to right now?
Yeah, I'm in a business group in the cities. We meet once a month. The manufacturing businesses, services businesses, things like that. On the manufacturing side, Matt, these guys and gals have huge backlogs yet, and they believe that backlog is going to continue to stay. And supply chains are getting a little bit better. They're not perfect. They're not back to where they were. So I just believe personally that I think a lot of this manufacturing is coming home. I think it's coming back from China, let's say. And I think that's going to help this market to kind of stabilize out. I don't think we're going to see a deep recession. I think unemployment's not going to go way high or up to 5% like the Fed kind of wants it. We saw some numbers of print today on unemployment that it's actually going up a little bit, which is what they want, which is weird because it's bad news. So I believe that this fall things will look a lot better than they do today. And I think the people that were prudent and stayed home and left their accounts alone and kind of looked the other way for a little while will be rewarded, or bought into this market that's down, whether it was last year or this year. I think they'll be rewarded down the road.
Way cool. It's fun when it's that simple for an update. It's just I like how concise all of that is. Anything else we should know before we let them go?
Nope. Just stay disciplined with what you're doing, and get a hold of a professional if you have questions or anything like that. So
cool. That's their expertise. We will see you back here next time on the iWealth podcast.
All right. Thanks, Matt.